By late 1913, the reform fight narrowed to two brass tacks questions. How many reserve banks should there be, and what exactly backs the money? In Warburg's collected essays, Should There Be 4 or 8 Federal Reserve Banks, and Gold or Lawful Money, Note Issue, Government Bonds, and Similar Questions, will unpack the trade-offs between the 4 versus 8 debate and the gold versus lawful money bond controversies that shaped the final bill. So, Warburg's through line is pragmatic. Few, stronger districts with real local plumbing and notes anchored in gold and self-liquidating assets, not bond privileges. On structure, he favors 4 big districts with regional and branch layers over a standalone 8 or 10 because scale plus clarity leads to faster coordination and cleaner statistics. On money, he pushes back against drifting towards bond-secured hybrid notes and insists that the system should lean on gold redemption and commercial paper backing, with member balances centralized and discount policy doing the day-to-day steering. So, let's start with how many reserve banks. Warburg uses a military analogy to explain the risks of too many disconnected units. 8 separate armies, for example, that can't reinforce each other without running to Washington is bad operations. Group them together and you can throw reserves where needed fast. Bigger units also make the picture clear. For managers in the Federal Reserve Board with the data grouped, problems are simplified and so policy can actually work. He's explicit that the exact geometry can be flexible. For example, 4 district reserve banks with regionals and branches, or 4 with 16 branches, but he strongly prefers the former for management clarity and better statistics. In his sketch, basically, branches keep this sympathetic touch with local conditions, and regionals are there to consolidate and allocate funds. And the district level presents a single, intelligible picture to Washington, for example, like weekly statements, flowing up and funds apportioned down as needed. He even notes practical advantages, so if stock ownership extends to the public, investors would rather own shares in larger, sturdier organizations in a 4-district design and can add regions later without tearing up the map. So Warburg also warns about governance drift. If Washington appoints all local boards or has to pass on every discount purchase, you recreate the very overconcentration of power the law was meant to avoid. And you slow the free discount market the system needs. Local discount committees should handle the paper and higher boards handle the policy. Now, what backs the money? Should Federal Reserve notes be redeemed in gold or lawful money? And should member banks be allowed to count Federal Reserve notes as reserves? So Warburg's view is crisp. Reserve banks must keep a safe proportion of lawful money against their demand obligations. The United States must honor its own gold promises on notes payable in gold. He then takes aim at a Democratic caucus amendment that would create a new circulating note as the obligation of the reserve banks, secured by 2% government bonds. He calls it a regrettable error, pointing out that it effectively recreates a bond-secured note, a second lien, paper, behind a government first lien with only 35% gold cover. Instead of moving to a logical system where all notes share a first claim on the reserve bank assets like commercial paper and ample gold, letting national banks count their own notes as reserves, he adds, is like a merchant counting his own IOUs as quick assets. So stepping back, Warburg's end state is clear. Simplify the currency, keep gold where it belongs and in reserve banks, retire national banknotes, and stop relying on bond privileges to prop up circulation. He later argues the Treasury should stop issuing small gold certificates and that greenback should be gradually retired as cover is built. So in conclusion, structure and backing are the hidden layers of stability. Warburg's 4 big units with regional plumbing is about operational clarity and fast reserve shifts, a system that can actually maneuver. His money backing stance is about credibility, anchor golds in a gold and real bills, not in bond privileges and accounting tricks. Get these 2 questions right, and the rest of the playbook, posted discount rates, bill markets, and inter-district cooperation, has a firm spine. So if you want to follow along, make sure to grab your own copy of the book. There's a link in the description, just like always. So